Hi, I'm Sonia Velez, the CFO here at the San Francisco Foundation. I'd like to welcome everyone to our investment and impact briefing. So during this annual event, we aim to provide our donors and community partners with an update on how we're managing and investing the philanthropic gifts that have been entrusted to us over time. That includes contributions made and funds that have been established by many of you joining us today. And we're very grateful for your generosity and your trust in the San Francisco Foundation. And I understand we have about 85 people with us today, which includes donors and fund holders, along with nonprofit partners, many of the professional advisors we work with, as well as foundation board members and committee volunteers. And we know that as a community foundation, we're most successful when we work in collaboration with all of you. And we appreciate that you also value living and working in a vibrant Bay Area where everyone has a chance to thrive. And as far as today's agenda, in a moment, you're going to hear from Mike Miller, Chief Investment Officer for Crucial Partners, an investment advisory firm that's been serving endowments, foundations, and nonprofits for over 40 years. And Mike and Crucial have been our partner at the San Francisco Foundation for more than 20 years. And we're very grateful for Mike's expertise and always holding us to a long-term perspective. And Mike's going to present the big picture and some of San Francisco Foundation as well as market data along with his insights. And then after that, you'll hear from Mark Doherty, our Senior Director of Investments, who I'm very grateful to have on our team. Mark's going to talk specifically about our investment pools and options we have for our donors and some of the connection to our mission. And then after Mark, we've set aside about 15 minutes to answer any questions that you may have. And after that time, Mike, Mark, and I will be joined by David Ibanali, who serves as the chair of our investment committee and also as vice chair of our board of trustees. And when he's not spending a considerable amount of time with us, David manages the venture capital firm Advance Venture Partners. And speaking of Q&A, I want to encourage you to submit your questions for the four of us using the Q&A feature on your screen. You can send them in at any time, and we'll try to get to as many of them as we can at the end of the presentation. So as a bit of context for what we'll be discussing, I just wanted to give you a snapshot of our asset makeup. So the San Francisco Foundation at our fiscal year end in June had 1.7 billion in assets, which includes over 900 million in endowed funds, over 600 million in donor advised funds, a little over 60 million in nonprofit agency funds, about 40 million in project funds, along with 27 million in charitable trusts that we oversee. So, and also in our fiscal year that ended in June, we had about 140 million in contributions coming in. And I'm glad to say 170 million that went out in the form of grants to hardworking nonprofits here in the Bay Area and beyond. So as a CFO, I couldn't work too many places that celebrate the fact that more resources went out than come in any given year. But that's often the case here. And that's how our mission works. And our strong investment returns help to make that possible. So as a community foundation, we're working with partners in the philanthropic, the public, the private sectors on critical systemic issues in our region. And we want to ensure an enduring impact for generations to come. And that's why we invest our assets in alignment with our values and our institutional commitment to racial equity and economic inclusion. While at the same time, we have the long-term objective of generating strong investment returns so we can achieve our goals and so we can maximize the resources that our fund holders have access to in order to make grants to the causes that you care about. And the last thing I'll say is we titled this briefing, Investing with Intention During Uncertain Times, because we want to acknowledge the moment that we're in as we've all been witnessing the shifting winds around expectations for economic growth, impact of emerging technologies, interest rates, we're in an election year, and how all of these things impact the markets. But we remain diligent regardless of our environment and whether we're experiencing bearable markets or economic or social uncertainty. And for those of you who've attended this event in the past, you know that while we might make adjustments, we don't really deviate from our strategy. And while we're not immune to trends in the economy, that discipline has enabled the San Francisco Foundation to continue to be a top performer when it comes to foundations and endowments across the country, looking at a long-term horizon. So on that note, I'm going to turn the program over to our investment consultant, Mike Miller. Take it from here. Welcome, Mike.
Good afternoon, everyone, and thank you, Sonia, for that very kind introduction. Sonia described the strategy here exceptionally well. And as she noted, we do live in a very complex time. And I'm frequently reminded at times like this that if we put aside some of the very serious issues, of course, that our society is dealing with and think about just purely the investment returns, how we generate them, the bad news is the uncertainty is uncomfortable and it makes us all nervous. And the good news is that it creates quite a bit of opportunity for long-term investors, and particularly in portfolios like this one with an oversight of a talented investment committee overseeing these assets. There's a lot of things that really kind of come along that we can capitalize on to enhance the value of this capital and its philanthropic impact in the Bay Area. So with that said, I'm going to walk you through some of the results and the strategy and a few comments on the markets in the world. And Mark is bringing up the slides. Thank you so much, Mark. So we'll start here just to level set the assets that the investment committee oversees on a very direct basis. And Sonia referred to some other assets as well. But here you see four major buckets that we are looking at as the committee looks at regularly, and we look at it crucial as well. So the endowment is $851 million. This is as of year end. The long-term pool, which is similarly invested, is $323 million. There's a short-term pool for shorter duration grant-making philanthropic time horizons. That's $271 million. And there's a mission-aligned investments pool, which is a relatively new pool. It's only a few years old now. It's $111 million, very exciting part of the foundation's options here and the way in which portfolio and capital can be aligned with the foundation's mission and values. So we advance to the next slide. Oops, there you go. Thank you, Mark. So now this is a quick snapshot of performance, and we're going to show you another slide in a minute, which I think really puts this in better perspective. But let me give you some information here. So first of all, there's an orange bar and a blue bar. The orange bar is the MAI portfolio, which is we referred to as mission aligned portfolio just a moment ago. That's the relatively new pool at the foundation. The blue bar is the long-term donor advised segment of that pie you saw a minute ago. And what you can see here is those portfolios returned about 12 or 13% last year, in that being the end of 2023. That's net of investment management fees. We also compare results to a 60-40 mix of stocks and bonds. That's the red bars. And then the Investmetrics Endowment Foundation median. So we're going to come back to that because Sonia made a reference earlier to performance compared to peers. And that is the median of a peer group that Crucial tracks and actually acquires data, which the investment committee tracks. And it covers about 1,100 endowments and foundations around the country. So it's a very good measure. And you'll see that for the year, both pools fell a little bit short of those benchmarks. That's largely because of the private equity portfolios that they each hold and a bit of a value bias on top of that. So we're going to talk about diversification and market risk and concentration a little bit later. But it's important to note that these portfolios are positioned to generate this very strong long-term returns we're looking for. Now, the orange bar disappears after 1 year because it doesn't have a 5-year record yet. But now you start to see some of the benefits of this very long-term patient contrarian strategy. It's not as easy to see on this page as I'd like it to be. We'll get to another page in a minute that makes it a little more clear. But what you can see here is the way in which the long-term, the donor advised pool, the core portfolio, as we call it, has outperformed by what looks like relatively modest margins here when you look at these bars, but in fact are very significant margins. And I also mentioned that philosophically, we very much consider the idea that while we'd like to have great short-term results, they're not as important to us by any stretch as great long-term results. So if we flip to the next slide, here you'll be able to see what that means. So believe it or not, these are the exact same numbers. Now we've dropped some of the bars. We just kept the core portfolio, the long-term donor advised, and the 60-40 mix here. The Investmetrics data would have also looked quite similar to the red bars as you saw before. But the difference between these bars and the ones you saw a minute ago were that these are cumulative. So those were per year, and these are not. These are compounded over time. And this is an incredibly important visual difference because at the end of the day, if you thought about those bars on the prior slide, the ones to the left, the 1-year returns looked more important and impressive because they were just larger bars, essentially. What this does is it really translates those numbers into what we really care about, which is compounding capital over time. And even what looked like relatively modest differences on that prior slide actually could become extremely large. So there's a couple things to think about. So you might say, oh, a little disappointing that you got 12.8 instead of 15.4 last year. Yeah, we'd agree. We'd like to always beat the benchmarks, but we don't always do it. As I mentioned earlier, some of the private equity portfolio, which has done extremely well over time, by the way, was a contributor to that. But you can also see the way this is now in a little bit more perspective. So for 5, as you can see, a 52% return versus 45 for the index. But then if you go all the way out to 15 and 20 years, massive differences in returns. And that's what's gotten the foundation into the top 5 or even top 10% of the universe of endowments and foundations over time. And those gigantic spreads you see over the red bar are extremely important factors in terms of compounding and creating philanthropic capital in the Bay Area. So we are very committed to a strategy that continues to try to deliver these kinds of outcomes. So if we flip to the next slide. So this is an insight into the differences in the strategic asset mixes of the portfolios. So the long-term pool you can see is 48% in stocks. The MAI or mission aligned pool is 60% in stocks. Then there's a big difference because the long-term pool has hedge funds and the mission aligned pool does not. Private assets are about the same level in the mid-teens. These are targets, but not actual investments. And then bonds basically are underneath that, about 20% in the long-term pool and a little higher in the MAI pool right now. So the differences in these mixes are in part difference around the objectives of the two pools, particularly around having mission-aligned investments. That's harder to do with hedge funds. And nevertheless, there's also other differences between these as well that I'll talk about in a minute. But the key points are at the bottom. The one is that this is a very heavy emphasis on high return asset classes. So the vast majority of this capital is in asset classes that can generate 8-9% returns or more per year. This is a very diversified pool. This chart, doesn't really do that justice. There's a lot more diversification underneath this as well. And here's the last point, which is really important. And it's actually something that is very, very significant in a time like this, that we are willing to accept volatility. We prefer not to have it, and I'm sure you would too, but it's going to happen. And so we have to accept it. And then we have to make sure that we capitalize on it and we get compelling compensation, as mentioned before. I also wanted to highlight the investment committee reviews these mixes once a year. They don't change them every year, but they do change them in reaction to long-term return drivers. So for example, what's the level of interest rates? What's the valuation on a long-term basis of the stock market? How do we perceive the opportunity sets in different asset classes? These are all different things that are inputs into the equation. I do want to make it clear, though, that at the same time, what we're not doing is trying to figure out what will happen this year. There's no prediction of a recession in these forecasts. We don't know those things are going to happen, so we don't try. So we really focus on long-term drivers of return. So we flip ahead to the next slide. Let's start with all of the different things that are happening out there. I'm just about ready to start my 38th year at Crucial. And I don't think I can recall a time that felt this complicated. And the bad news, as you'll see in that very far right-hand bar, is that indices like the S&P 500 are increasingly concentrated in the Magnificent Seven, which I'm sure you've all heard of too many times by this juncture. And one of the things that's kind of challenging about this time is that you have a concentrated index, and concentration and risk in the investment world are synonyms. So it's really important to think about higher concentration is higher risk for the index. And so it's interesting to think that when we have higher inflation, we have a very different monetary policy right now in both the US and elsewhere, i.e. the era of quantitative easing or bond buying, or sometimes referred to as free money, is over. And that's created some significant multi-year, potentially decade-long plus changes in the way markets function and the way things are valued. The second point is capital scarcity. Once you pull away all these trillions of dollars being thrown at the markets, it does create a very stark difference between winners and losers. So again, more risk, and more risk across the equations. This is a very interesting time, especially because we're all very much cognizant of the uncertainty. So we go to the next slide. As Sonia mentioned, it is an election year. There we go. Thank you. It is an election year. And we thought it'd be interesting just to show you how, at the end of the day, the parties in power and the machinations and the combinations of these things, really, there's a relatively tight spread of returns across these numbers, frankly. And I will tell you, this is a great example of what we sometimes have. So I did my master's degree in statistics, and one of the things they teach you early on is you can have correlation, but without causation. And I'm not so sure this is correlation and causation in most of these cases, because it's kind of just a lot of interesting numbers that I'm not sure mean much as a predictive force, in part because political parties will change over time. And there are many, many other factors that affect markets, not just who's in power. But nevertheless, we are an election year, as Sonia said. And so I think it's important to remember that. We can't really change portfolios based on that. One, because we may have goals and interests in what happens, we can't predict it, nor do we know exactly what markets will do. So we'll flip to the next slide. And we really want to give you a sense of this concentration question. This is a really, really, really big point. And I hope if you walk away from today's presentation, in addition to appreciating the wonderful results of the San Francisco Foundation, the wonderful impact the foundation has vis-a-vis the assets and the way it deploys it and the way that grants and other funds are deployed in your community, if you walk away with those two things, great. The third thing I would like you to walk away with is a little more fear around these indices and how things are going. And so just as a level set, the way indexes work, especially like the S&P 500, is each company's weight is determined by its size or its market capitalization, we call it. So that's the number of shares times the price. So stocks that do really well, of course, get bigger and bigger and bigger, and they can become bigger and bigger parts of the index. And so right now, this isn't even the Magnificent Seven. This is just the top 5 names. Microsoft, for example, is the biggest in the world right now, followed closely behind by Apple. And what you can see here is that if you go back to 1990, those top 5 names have actually not ever been quite as big a percentage of the index as they were before. So this is when I say we do live in a very unusual time in many respects. And one of them is the indices and just how concentrated they can be. Now, again, just to be clear, the fact that the index is concentrated, doesn't mean it's going to do poorly. We're not saying that, but it does mean that it's more increasingly dependent on just a few companies. And I think that's a really big challenge for it as we go forward. So we go to the next slide. This is the other message I'd love you to walk away with, is that I think the best, I heard an expression years ago, which I love to repeat, so I'll repeat it now. I'm not going to properly attribute it, so I'm not going to try. But the expression was, risk is greatest when agreement is greatest. And I think that's a super important concept to remember. And I think one of the things that you learn as a long-term investor, or any investor you should learn, is that popularity is not your friend. It feels good to be with the cool kids and be popular, but the reality is it's not good for you as an investor. And this chart you see here gives you a sense of how that looks and what that means. So essentially what DFA, which is Dimensional Fund Advisors, did is they went back to 1927 and they basically said, well, what happened to the top 10 names in the US stock market? So before they became the top 10, which are those bluish bars to the left, you can see that basically returns were extremely strong, which is no big surprise. That's how they became the top 10. So that's kind of self-evident. But what might be surprising to you is what happened next, which is that with the exception of 3 years, they significantly underperformed the rest of the market for the next 5 and 10 years. Again, that's per year, so it doesn't look like a lot, but you do those compoundings like we showed you earlier, it's a really big deal. When you already have a fairly expensive index, if you took 1.5% per year off of that, you could end up with a really, really low rate of return. So I guess what this slide says is a lot of things, which is if you're really good, and we try to do this, I'm not sure we can get it right all the time, you really want to own them on the left. You want to own names before they're the top 10, not after they're the top 10. So think about that in concert with the concentration of the index we showed you a minute ago. So we turn to the next slide. Here's just one more look. So there's always an argument that can be made, and it's not necessarily an unreasonable one, about how this time is different. Oh, those are dangerous words for those of you who've been around for a while. We thought it'd be interesting just to look at the market in a slightly different way, because part of the argument for things like the Magnificent Seven is that these are massive companies that are earning at levels that are unprecedented for companies of their size. So the scale and the power of their business models is quote unquote unprecedented. Now we're a little skeptical about the unprecedented part, because I think all good things come to an end and there will always be new competitors coming along. And a lot of this Magnificent Seven didn't even exist 20 years ago. So I think it's interesting to think about that. But put that aside. So what you're looking at here is the various economic sectors in the S&P 500. And then they just, what all this graph does is it breaks out the Magnificent Seven as a separate sector. So it takes it out of wherever sectors it actually belongs in. And what you can see here, that first numerical column where it says earnings weight, that's the percentage of the S&P 500's earnings that were generated by that sector. So you can see actually the largest contributor to earnings were financials, banks, insurance companies, et cetera, asset managers. The next number, the 13.2 next to it, that's its weight in the index. And so the value difference is, okay, if it's a 13.2% weight, but it generates 21.6% of the earnings, then it's basically got an 8.4% spread positively towards the earnings away from the weight. But now look at the last line at the bottom, which is the Magnificent Seven. So first of all, those 7 names are 17% of the earnings, which is remarkable. But they're 28% of the index, at least as of the date of this chart. And so they're a negative 11.4. So what that suggests is that there's a gigantic amount of optimism in those prices, and that essentially what this would say in English is that these stocks are going to grow at an unbelievable level over the next, really whatever period of time you want to use. And there's evidence they can grow quicker than the market, but that's a big spread to catch up to, from a 16.9 to 28.3. So this is, again, back to that concept of expectations, risk, popularity, not always things that work in your favor over time. Let me jump ahead to one more slide. Just want to reiterate the strategy one more time. So we will overcome this uncertain climate by, first of all, frankly, at the end of the day, thinking about it a lot and how it affects the investments on many levels, but not trying to predict it, not trying to figure out how to get ahead of it, not trying to figure out what will do better, what will do worse. We're not in the predictions business. We don't believe in coin tosses. But if we use contrarian investments, and we avoid areas like I just mentioned where we have no edge. No one at Crucial or on the San Francisco Foundation Investment Committee knows what the world will look like a year from now or 2 years from now any better than anyone else does. And so that's not part of the strategy. The second part, which Sonia mentioned, and I want to just emphasize again, this concept of patience and a long time horizon actually is really, really a great strategy during an uncertain time. Volatile, uncertain times are the fuel of these kinds of strategies. And I will tell you, just traveling around the world and various places, patience and long time horizons are increasingly rare commodities, unfortunately. And I think that's unfortunate, but it's good for the San Francisco Foundation's investment outcomes as we look forward. And last but not least, the San Francisco Foundation is one of the preeminent endowments in this country and in the world, and capitalizing on its reputation, the scale of the assets Sonia mentioned before, to invest opportunistically and to access really exceptional investors across a very well-diversified asset mix is a really significant edge. And frankly, despite all the challenges of overseeing these assets, investing in these assets, advising on these assets, these advantages are so important and give us, make it a little bit easier for us. So with that, I'm going to pass it off to Mark, and thank you for your attention. I really appreciate it.
Hi, everybody, and thanks, Mike. I appreciate your comments. It's a pleasure to be with you. As Sonia said, I'm Mark Doherty. I'm the Senior Director of Investments here at the Foundation. And I have a ton of information that I have to share with you today. So I'm going to cover three things before we move to the Q&A. And just as a reminder, please feel free to drop your questions into the chat. I appreciate us seeing that a few of you have already done so. Please continue to do that. We'll get to those right after I'm done. But today I'm going to talk to you about three different things. First, I'm going to share out about our governance and investment approach and remind you of the investment options that you have available to you as a fund holder here at the Foundation. I'm going to talk to you about how we invest intentionally to advance our mission and increase the alignment of our investments with our mission. And lastly, I'm going to talk to you about two investments that we've made recently that are really trying to intentionally address lingering systemic challenges that we see in two distinct places in the asset management space as well as affordable housing. So again, our mission here at the Foundation is really about trying to advance greater racial equity and economic inclusion in the Bay Area. And if you've ever heard me speak before, I like to start my presentations off with a little bit of a grounding and framing around data and context. So today I'm going to talk to you about persistent racial wealth gap and just give you some numbers as to the enormity of the problem that we're trying to work towards solving. So 4 years ago, we all started to live through the pandemic. Now here we are 4 years later, and good news. In that time, wealth has increased across the board in the United States. Across all the demographics, net worth for families have increased. Bad news is that the racial wealth gap in that same time period has exacerbated, it's worsened. So according to the Fed's survey of consumer finances in 2022, white families had a median net worth that was $240,000 greater than Black families and $220,000 greater than Latinx families. This is the largest gap that's been in place since the Fed started tracking this data 40 years ago. Why is this? Why is this happening? Well, one of the really, I think, key pieces of the puzzle comes to the word equity and the lack of participation in equity by non-white families within the United States. So just a few other data points for you quickly. When you look at the stock market, 65% of white families hold stock, publicly traded stock. that Mike was just talking to you about, whereas 39% of Black families do. Private businesses, 85% of private businesses in the United States owned by white families, 3% are Black. Homeownership, 73% of white families are holding a home, and only 44% of Black homes. So right there, you're talking about three significant systemic challenges that are in place that we continue to work and grapple against and sort of work uphill towards solving. So I'm going to share up a screen again. So just bear with me while I do that. And we're going to walk through some slides. All right. So I want to start by grounding you and orienting you to how we oversee our investments. So the board of the foundation has delegated oversight of the investments to the investment committee. And these are the folks on our investment committee presently. There are 3 board members. That's Molly, Justina, and David, who you will be meeting shortly. And then we have 4 investment professionals from the Bay Area who generously contribute their time to us and help oversee all of the assets. Mike Miller and Crucial Partners are the folks who go around the world diligencing all of the prospective managers. They bring those managers to the committee for recommendation and approval. And then my tiny team of 3 helps to oversee all of the assets that we have invested. And that's north of over 100 different funds. And I just want to put a quick shout out of appreciation to Jeannie and Nathan. Nathan, who's actually going to be leaving us shortly to head off to new adventures in SoCal. And I really appreciate all of his hard work in the years he's been with us. Now, in previous decades, institutions would often have 2 separate approaches to overseeing their assets. And I want you to take this Venn diagram and separate it into 2 separate circles. So on the one hand, you would have financial returns, and then on the other, you would have social returns. So in the financial returns side of the equation, endowments and foundations would really try and generate maximized returns so that then over on the social return, they could give 5% away into grants in the community. Now, what we've been doing at the foundation is really trying to increase the overlay between these 2 and increase the Venn diagram overlay. And I'm just going to take a moment and walk you through this slide and give you an understanding as to where the various options are for fund holders at the foundation. So as I said, we work with over 100 different investment managers. They utilize a range and a spectrum of investment approaches in their work. That includes traditional investment managers that are really focused around generating financial returns. We have other managers that are working with sustainable and responsible investment strategies. And then we also have impact investment strategies. Beneath that, in this table, you're seeing the options that you have as a fund holder. So when you come to the foundation, you can open up a fund, and it can either be an endowed fund or a donor advised fund. And if it's a donor advised fund, you're then going to have 3 options to choose from. That's the long-term pool, the short-term pool, and the mission-aligned investments pool. The long-term pool and the endowment are pooled together and grouped together on this slide because we utilize the same managers for that portfolio. It's just that the asset allocation mix is slightly different with a little bit more fixed income in our long-term pool because we need to be able to have liquidity available as and when our donors want to make a grant and recommend a grant out of their DAF. As Mike was saying, the short-term pool is a short duration, more conservatively postured investment approach with an expected return, really trying to keep a pace with historical inflation net of returns. And then we have our 2 impact investment strategies that I'm going to talk a little bit further about, which is our mission-aligned investment program and our Bay Area Community Impact Fund, which is really about making place-based, community-focused loans from the foundation to nonprofit organizations that are doing work in our community in the Bay Area. So I'm going to spotlight now 2 different ways that we advance our mission through our investments and literally putting our money where our mouths are. And that's going to be through our expanded impact investment program, as well as investing with diverse managers. So what you see here on this chart is 2 different donuts. The one on the left on your screen is from 2017. And the way to read through this is that at the time, we had for donors a socially responsible investment mutual fund that was an option available for you as you opened up your DAF. This was sort of a predecessor to that mission-aligned investments pool. So we had around $70 million in that. And then we also had that loan program, the Bay Area Community Impact Fund, that we had seeded, and it had grown up to around $8 million at the time. And then there was everything else. That's that dark blue with around $1.3 billion. Now, if you move over to the right side in 2023, and this is as of the end of the year, calendar year 23, This is where our assets stood at that in December. And we're really delighted to see the way that the dial has turned on this, and it's very intentionally been done. So to just walk you through the different colors here. So the mission aligned investments pool, as I talked about a moment ago, this is a program that we began in 2019. We started it with $50 million at the time, and it's since grown to $111 million. Additionally, we've had other managers in the other pools, that's the long-term pool and the short-term pool, agree to invest their funds in alignment with the mission-aligned investments pool investment policy statement, right? So they're adhering to the same rules and guidelines that we have in our impact investment program. And that's capturing that $455 million that you see there. The lighter blue, the BASF and Bespoke PRI. This is a program, as I said, this is our community lending program, our program-related investment strategy. And we began this in 2009 with $5 million, and it's now grown up to around $33 million for our Bay Area Community Impact Fund. And we're actually making allocations from our long-term and our mission-aligned investments pool into this strategy for the past couple of years. And so we are increasing the scale of this program because there's so much demand in community for our loan facilities to help these organizations realize the impact that they're trying to accomplish in the Bay Area. Additionally, we have now these bespoke PRI, and these are loans that we're making where a fund holder comes to us and says, I'd like to make a loan from my donor advised fund to an organization in the Bay Area, and that organization is doing work that's advancing the mission of the foundation. We've done a collective of around $41 million of those are outstanding right now to organizations. So between the $33 million we have in our Bay Area Community Impact Fund, the $40 million that we have outstanding for the bespoke loans, that gets us to the $74 million. And then the everything else number is now $935 million. And I don't want you to walk away thinking, okay, well, Mark just told us that, 40% of the assets of the foundation are invested in alignment with the mission. Well, then 60% are not. But that's not the case, actually. It's just they're adhering to and are very impactfully focused around our strategies. We actually only have around 4% of our assets invested with fossil fuels, and we do not have any investments with predatory lenders or private prisons. And we're really proud of that progress that we've made, and we continue to hope to have this dial and that donut turn in colors. The other way that we really reflect the values and the intention of the foundation is through the consideration of the ownership of our investment managers. Diversity is really a key approach to all the work of the foundation. That includes the way we do our investments, where we make our grants, how we do our vendor selection. Now, you all know that when you think about your investment portfolio, the diversification of your asset classes is really a primary driver of investment returns. And that too can happen through consideration of your investment manager mix and the actual who are those individuals who are making decisions with your money. So research has shown that around the world, around only 3 to 5% of global assets are overseen by women or people of color. At the foundation, as you see on the left side of the table of this chart, 37% of our assets are overseen by firms that are majority owned by women or people of color. And on the right-hand side, what this is showing you is the number of funds that we've invested into through our strategies. Going back in 2016, we had 2 funds that were majority owned by women or people of color. And now that number's grown over to 27 at the end of 2023. And when you disaggregate that 37%, it's around 27% are allocated to firms that are majority owned by women, and 13% are led by people of color. And obviously there's some intersectionality there between, let's say, a Black woman as an investment manager. But as I said, this isn't just around investments. The foundation also considers diversity when it comes to the grant-making strategy that we have. So in its last fiscal year, we reported that we made around $48 million of grants from our endowment, and 80% of those went to BIPOC-led organizations. We're really trying to put dollars into the hands of individuals who are closest to the problems that we're trying to solve within our communities. So now I'm going to wrap up with a couple of examples of investments that we've made to address systemic challenges that are persistent, as I said, within the asset management space, as well as affordable housing. And the foundation really tries to focus on upstream problems. So even though we've made success, as I was just telling you about, in terms of allocating to diverse managers, and that we've seen momentum amongst endowments and foundations, that 3 to 5% of assets that are held by diverse managers, that number really hasn't moved up significantly over the past several years. And so we, as staff, as an investment committee with crucial partners, have been asking ourselves, what more can we be doing? And I just want to draw your eye to the second bullet point here that really blew me away as I was preparing for this presentation. And what this says is that 70% of white institutional asset allocators believe that if they were to incorporate diversity into their investment decisions, they would expect to see a reduction in their investment returns. So institutional allocators, what is that? That's, state pensions, large endowments, sort of large pools of capital. And this, I think, was a really staggering statistic for me because it really speaks to, within the asset management space, a lingering bias that is being held as to the keepers of a large billions and billions of dollars of assets and the biases that people are holding when they're thinking about how do I allocate my money? Should I give it to a white male-led firm or to a woman-led or to a BIPOC-led manager? So we found a firm called Expect Equity. Now, this is a woman-led business. And what they do is they provide back office and infrastructure to diverse public equity managers. And the real live example here is what we did is that we took $15 million from our core portfolio, that's from the long-term and the endowment, and we made an investment into Expect Equity. She then took those dollars, as well as money, obviously, from other investors, and she seeded it into 2 female investors. These 2 women had been trading and working together at an investment management firm for over 15 years together. And they'd always been talking about maybe we can break out and do our own, hang our own shingle one day. And they just were unable to do it for a myriad of reasons. So literally what they did was they got hired on with Expect Equity. They stopped trading at their investment management firm on a Friday. They started trading on their new book on the subsequent Monday. And we're really excited about this new and innovative approach. And we're hoping that other institutions follow us and help us tackle what I think is really sort of a lingering problem of allocating capital to diverse managers. The last topic that I'm going to talk to before we head over to the Q&A is around affordable housing. Now, we all know in the Bay Area that housing is a huge challenge, and there is an enormous amount and a very long list of causes to what homelessness is coming from. That could be around redlining, racial wealth gap, the absence of an effective social net, the skyrocketing cost of housing in the Bay Area. And I'm just going to talk to you about one organization here, San Francisco Housing Accelerator Fund, that we've been partnering with for the past several years, and ways that they've been able to successfully tackle and come up with creative solutions to really what is, I think, been a pain point in the housing problem for quite some time. So how are we related? How do we engage with SF Half? So we began working with them in 2019. We gave them a $2 million loan out of our Bay Area Community Impact Fund. That's that community loan program I was telling you about. And then additionally, we've set up a program with them, a loan facility. This is one of the bespoke PRI loans that we have, where we have a $25 million loan facility that other donors have put money into directly. So when you put the two together, we have north of $27 million that have been lent to SF Half for them to be able to do work around housing in the Bay Area. Now, the project that I'm talking to you about is listed here and shown in the picture. That's on Bryant Street in San Francisco. And typically a housing project in the Bay Area costs somewhere around $600,000 per unit. And it takes you around 6 years to complete. This project on Bryant Street was done at around $400,000 and in half the time, in 3 years. So how were they able to do that? And what was really our role, and how did we help facilitate this more efficient approach to solving for homes? 2 things. One, SF Half used, they used compartmentalized homes. The word escapes me, prefab units, that's it. And they were able to bolt them together. But then where we came in was that we gave them flexible capital through these loan facilities. And what that allowed them to do is it paid for pre-development costs, construction costs, without having to deal with regulations, paperwork, expected ROI that other funders and other lenders might provide and expect from them. So in total, SF Half has been able to have significant impact. They've generated over 2,500 affordable units across the Bay Area. 1,400 of those have been preserved, 1,100 plus have been produced housing. And now they're taking their recipes for success across the 9 counties of the Bay Area, and we're delighted to continue to be a partner with them. So now I'm going to stop sharing my screen, and we're going to take everybody else who's been speaking, and we're going to start the Q&A process. So just bear with me as we do so. So just one second, folks, as I get my little Q&A tab up here. All right. So one of the questions that came in, and I'm going to start with a question for you, Sonia. The question was, with the short-term pool, do you still focus on long-term? Could you speak to how we think about the short-term pool, please?
I think where we focus on the long term is through our investment policy and our emphasis on high credit quality. And over the long term, we ensure that this pool beats money market funds. But the primary intent is to provide liquidity when it's needed for grant making, for expenses, et cetera. So it's obviously not quite the same long-term focus in terms of the economic environment, because the weighted average life of that pool is under 1 year. The effective duration, if you're into fixed income stats, is less than 6 months. Typically, the longest security we would ever hold in that pool is 3 years. So, we're looking, that manager is looking a little bit more opportunistically at what's going on in the interest rate environments and supply and demand in the fixed income portfolio. But our objectives and our policies remain with a long-term focus in terms of saying, is this pool doing what we want it to do for the foundation?
So David, over to you. Question for you. One that's come in, two things. It's a two-part question. One is, could you just expand a little bit about the relationship of the board and the investment committee and how they really intersect with the deployment of the assets? And then where do you see great investment opportunities perhaps occurring in 2024?
Okay. So I think the board investment committee, and remember when Mark introduced the investment committee, there were two types of members on the investment committee: folks who are on the board and folks who are not. The investment committee is designed to advise on the deployment of capital over the long term against an investment policy statement or a set of policy rules that dictate what we do over the long term. And so we're making decisions that are about fund managers to back, about the composition of the portfolio. And over the long term, that gets set by the board and the investment committee together. And then as we build the investment committee itself, we spend a lot of time thinking about members that bring specific perspectives to that investment committee, so that in the case of, for example, real estate, we know we need some amount of real estate in the portfolio, and that will be determined by that sort of investment policy statement and the investment committee's long-term perspective. But we may need people on the board on the investment committee who can speak to the asset class, and if we don't have that expertise, we'll find it and add someone to the committee that has it to help inform our decisions, so that between the committee members and Mike and his staff, we have perspectives that can inform our decision making. Where I find the question about where we're looking for opportunity right now is not about, this sort of speaks to Mike's point, it's not about 2024, it's about where do we see 10 years of great returns in capital that we're deploying in 2024. So we're not thinking about where's the stock market going to be now and where's it going to be at the end of the year, but we're thinking about what asset classes are likely to be mispriced in 2024 so that we can invest and over the next decade generate fantastic returns for the foundation. I can tell you where we don't see that right now is we feel I don't think we feel comfortable finding it in domestic growth equities. I think we have continued to try to be biased to value, and in an interest rate environment like the one we've got, in an inflation rate environment like the one we've got, we're looking for things that can generate returns irrespective of those impacts. And so I think while we're not shifting the portfolio rapidly, we're thinking of places where that opportunity set's becoming more interesting rather than less.
Great. Thanks, David. Mike, this one's going to be over for you. You talked in your presentation about the top 5 companies taking up so much of the S&P. Are you saying that it's dangerous to put all investments just in the S&P? That's one question. And then the second piece was that you talked about the Magnificent Seven as well. And could you contextualize, like, what is our foundation's exposure to the Mag 7?
Yeah, sure. So the word dangerous is probably not a word I would use. What I would say is David just said something I thought was a super important perspective around, how you should think about investments if you have a long horizon, which is to make investments where you feel like 10 years out, you will have compounded your capital at a very high rate and appropriate rate of return given the risks you're taking. That was another way of saying what David just said a minute ago. I think our problem right now is if you think about the S&P 500, I think it's harder to get to that answer. It's not, though, the market's going to crash, the S&P is going to lose a lot of money. We're not saying that. We're saying it's probable, frankly, that the S&P 500 just doesn't generate very high rates of return for the next 10 years. It's sort of, a bit of catch up because we just had a great 10 years before. And so that's how things work. You get a great decade, then you get not so great decade. So I don't think it's dangerous. I think I would probably turn around the question and say that it's not dangerous, but you could do a lot better. And I think that's probably the challenging point. And I think David just basically listed a few of the many things you could do that would be better. I think people have to kind of get out of this, the S&P has worked, so it will work mindset. And that's what we're really trying. That's the message I'd like to send, is that this is not a guarantee that it continues to be the leader. In fact, the odds are it won't. With regard to the Magnificent Seven, the weight is very small. The portfolio, I think the most recent statistics I saw was we had about 6% of the equities in the Magnificent Seven. I believe they are about 29% of the S&P 500, at least they were last. It was 27. We had that slide before, excuse me. So we're way underweight. And in fact, most of the exposure we have to them is through we have an enhanced index fund. So that manager is going to hold the Mag 7 to some degree because they're trying to keep their tracking month-to-month returns close to the index. So I hope that answers that question.
Yes, it does. And Mike, I'm going to stick with you. Another question that came in. We're going to sort of pick up the pace and make these into lightning round questions.
Yeah,
folks. So another one came in was, do you invest in other countries, i.e. developing countries? And
yeah,
yes,
absolutely.
you do, but didn't know if you wanted to mention anything in particular about exposure or areas of interest.
Yeah, it's pretty global. So we have investments in Asia, Southeast Asia. We have investments in Central Europe. We have investments in South America. We have investments in Africa. So really everywhere that you can find a great business. And outside the United States, you frequently find them at much lower prices than you do inside the United States. And some of these are global businesses, so it's a real arbitrage to be able to invest around the world, as the question suggests.
Okay, and then Sonia, for you, a question came in. I've read a lot about ESG, and some have views that are very negatively held. Could you talk a little bit about how the foundation thinks of ESG and how you reflect that maybe in the investment approach?
Yeah, it's interesting that ESG has become a politically charged issue when really the way we see it from an investment perspective is it's a smart way to manage risk. That if you're not thinking about environmental, social, and governance factors, you're not fully evaluating an investment. And we actually do have a statement in our investment policy statement that says that we will consider ESG factors actively as part of our investment practice.
And then, David, a question came in terms of our investments in the fixed income space. Why has the foundation chosen to invest in only long-term fixed income rather than a mix in the long-term pool? David and Mike, I think I'm going to jointly put that to you. Maybe, Mike, you want to start off on that? And
David, do you want me to start?
Yeah, start.
Okay. Yeah, it's actually pretty simple. The reason that we've done it this way is that the endowment / the long-term pool, the core portfolio, doesn't really have a lot of fixed income. And so the way we view the role of fixed income isn't protection necessarily against rising interest rates, but it's a hedge against all the equity exposure we have in the event of really bad economic times or a huge market shock, because interest rates do tend to fall in those climates. And so when you have a smaller fixed income portfolio, it's really important that it provide a really powerful equity hedge. And that's what longer term bonds can do vis-a-vis shorter term bonds, which just really mostly preserve capital and protect you if rates rise. But we're not as worried about that.
Okay. And then Mike, I'm going to stick with you, but then I'm going to bring David into this question. So first is, can you share with us your philosophy behind the portfolio construction, particularly MSCI weight in the long-term pool? And then David, I want you to start thinking about just that broader question of the philosophy of the investment approach for the foundation as you think of it through your board member lens, okay? So
Right.
Mike, over to you.
Sure. So there's a few things. So one is, I think the operating principle here is that we're trying to do what David said, put together a portfolio of investments that have high returns. At the same time, what we're trying to do is make sure that they're diversifying vis-a-vis each other. So that's why you diversify globally. That's why you have value stocks and growth stocks. That's why you own different sectors in the market. And you think about it that way because all of these things are meant to diversify. And then the way we construct the portfolio is we have some very significantly sized core diversified market-like positions. And then we have some very idiosyncratic concentrated positions that all basically work together to provide essentially a lower risk in our way of thinking portfolio. And that's a critical element. The way we end up looking vis-a-vis MSCI is also based on a similar principle, which is that we want to be very diversified. And we're of course going to be, as the US economy, the US markets are a powerful and robust source of returns and a robust source of companies to buy. So we're going to own a lot of those, but we're also going to not do so to the extent that we kind of squeeze out everything else, Europe, Asia, the developing markets as well. So we do tend to be underweight the US vis-a-vis the indice, the MSCI indice, but we have it's the biggest exposure we have. So I think it's really important to remember that we still own a lot of US stocks.
And then David, over to you.
So I think the philosophy, the foundation has generated top decile performances for a couple of decades. And the first principle is how do you not erode that? How do we continue to generate fantastic returns? Because that enables us to do all the other good work we're doing. And so you could have a philosophy that is make as much money as you can, toss it over the wall, let the grant making pursue its needs, and the two shall never sort of meet. If you remember, Mark showed a sort of Venn diagram at the beginning, and that Venn diagram is sort of what we're trying to achieve. And that Venn diagram is how do we pull the mission of the foundation and the mission of the investment committee into some overlap. And the question will be over time, how much can we do of that without eroding returns? We think we can go a pretty long way. The beginning of that is investing in diverse managers. We are diametrically opposed to the view that requires returns to be eroded. The question is, are you capable of looking? Do you want to look? Do you want to have conversations about it? Not about whether or not you can find highly performant, diverse managers. The second piece of it is how do you bring pieces of the investment portfolio that are supported by outperformance elsewhere into larger scale by investing against the mission more closely. And what you've seen in the performance since its inception is the mission-aligned investment pool has performed almost in sync with the core portfolio. And so we've done the beginning of that well. And then we have a couple of different vehicles that are more tied to the mission that we're willing to sacrifice returns on because they're close to mission, and we're compensated for that by outperformance in the fund elsewhere. And so I think we have plenty of room to continue to do what we're doing, and still do so with, again, top flight returns relative to the rest of the endowment and foundation world, and at the same time, great impact relative to our mission.
Great, thanks you all. I'm going to just finish off with one quick operational question that had come in, and then the others that we didn't respond to, we're going to follow up in our donor relations team. I think we're going to figure out a way to capture the questions and then post the responses collectively out. So One quick question that had come in operationally was, how do I update my funds allocation? So if you have a fund with us, the easiest thing, you can change your allocation at any time and just contact your donor services team or your philanthropic advisor here at the foundation. I personally am happy to meet with anyone who wants to talk about their investments a little bit deeper. And you get your quarterly fund statements. Those just recently came out as of December. So we definitely appreciate that. And now, Sonia, I'm going to send that over to you to close us out.
Thanks, Mark. So thanks so much for all these questions. I know we didn't get to all of them. If we didn't get to yours and you'd like more information, please feel free to reach out to your philanthropic advisor if you're a donor, or to our gift planning team if you're a professional advisor. We'll be sending a follow-up email in a few days, and we'll have all of our team's contact info listed there so you can easily find it. In addition, our follow-up will include a very brief survey to gather your feedback, and we'd love to hear from you. That's very important to us, so we'd appreciate if you could take a moment to complete it. And we'll also provide space for additional questions or requests or follow-up there. Before we end, I just wanted to thank Mike and Mark and David for sharing their expertise and insights with us today. So that concludes our session. Thank you all very much for your support of the San Francisco Foundation and for joining us today. And please be on the lookout for invites to future events. We really hope to see you soon.